So it's time for your initial loan disclosures and your loan estimate, or LE as we call it. Let's take a look. When you buy a home, it makes sense to have lots of questions and want to know what all these fees are. Every lender who receives a loan application is legally required to send a loan estimate within 3 days to that applicant. The need for a loan estimate is legally required when a lender receives 6 pieces of information. This is the borrower's name, social security number, income, loan amount requested, estimate of the property value or the sales price, and the property address. Here is the first part of page 1 of the loan estimate. The loan estimate is basically a good faith estimate of the lender's best idea of how much this loan is going to cost you. Think of it as a map that gives us the best guide we can see of your loan. There are some things that we know for sure, the interest rate and our charges. However, there are many third parties involved, like homeowners insurance, title companies, where we have to estimate to our best ability what those charges will be, what they normally are. Looking at the details here, just double check your name and property address and sales price. That should match what is on your contract. Check the loan amount, and usually the difference between the sales price and the loan amount is your down payment. Unless you're using a program like FHA or VA, this may include a funding fee as well. Check the principal and interest. If you're having mortgage insurance added, check that amount and your escrow amounts, and you will see your total payment. These are the amounts that can change in escrow because they depend upon the amounts you get from your homeowner's insurance premium and the county taxes each year. So those can change, but your principal and interest payments are set. At the bottom are your estimated closing costs and estimated cash to close. Keep in mind that closing costs and cash to close are not the same. Cash to close will be the amount that you will be expected to bring to closing table on closing day. Page 2, Section A is what the lender is charging for the loan, and these do not change. This is one of the reasons why a loan estimate exists, so that a lender can't say we are going to charge this much at one point and then get to closing and it's a whole lot more than they said or you were expecting. Once this fee is given to you, we are bound by this amount and it cannot change. Section B are third-party fees that will not change significantly but are not exact. They're still estimates as we wait on invoices to come in. The title fees are there to protect you so that you have a clear deed of home ownership, and it protects you from any claims against that deed and title. Prepaids are normal. There's interest from your closing day to your first payment. Since you have a time period between closing and your first payment, the interest is still accruing each day. Section G of escrow is there unless you have chosen to waive escrow, which is allowed on some programs, but for most people, they do choose to escrow and allow the lender to collect those fees and pay their taxes either annually or twice a year, or also include their homeowner's insurance premiums to be paid out. There's always a buffer to create room for any adjustment on any tax fluctuation or insurance premium changes. Owner's title is separate because it is optional. It gives you extra protection to title claims. But some people do choose to waive that option as well. Down at the bottom right where your calculated cash to close is includes any earnest money or seller credits will show up there, and then in the right corner again is your estimated cash to close, which is close to the amount you will need at the closing table. Page 3 shows what happens in 5 years with your mortgage and the payments that you're making. Most people only retain a mortgage for 5 to 7 years, and then they either purchase or refinance. The APR here is a way of expressing your total cost as a percentage. It includes everything like appraisal cost, title cost, the overall cost in your 30-year term loan. Total interest percentage is the total amount of interest paid over the loan term. Other considerations are for your information. The rules in terms of assumptions and insurance and servicing. Here at Movement, we do retain servicing of our loans, which is great because you deal with movement for life, and we can keep a check. Our servicing department checks on rates, and through the years we'll let you know if it's a great time to refinance, and we can waive some of our lender fees since we are servicing a loan that we originated as well. At the bottom is where you sign. Signing here just says, hey, I recognize and I have received this loan estimate. I know that it is an estimate and final figures will change, but the signature is what allows the process to move forward along with the next page. This is a sample of the intent to proceed, which is included in your initial loan disclosure packet. This is another form, along with receiving and signing the loan estimate that we just talked about, that allows everything to move forward. Unfortunately, real estate is not a simple purchase, and many people are involved in helping you purchase, and many of the fees are unknown of exact amounts until all the invoices come in. This is why the closing disclosure is more accurate. Most of the invoices have come in and adjustments have been made on the initial CD that will go out and require your signature closer to closing, and on the final CD you will know exactly what you need to bring to the closing table on closing day.